Good morning, everyone. Good morning, Prashant. Good morning. Okay, so today we have another standard to cover through as part of our revision, that is Ind AS 12, that deals with income taxes. Okay, so basically, this is what we commonly know as deferred tax. Okay, so now when we talk about taxes or income taxes, why is this a very critical standard and why did we have to introduce this? So we'll be covering the objectives, the definitions which are involved in here, and we will run through what is the methodology to calculate the deferred tax. After the deferred tax, we will look at some special cases, changes in tax status, and certain disclosures. I'll be running you through some of the additional questions. And with that, I think you should be comfortable. Obviously, the recorded sessions would be available for your review. Okay, so let us start. Why do we need Ind AS 12, that is accounting for income taxes? Obviously, the intent is to account correctly for income tax. When I say account correctly, what do we mean by that? So you would be aware that in your income tax, there is, when you are computing your income tax, you start with the P&L as per financial statements. You start off with the profit or loss as per the statement of P&L, and the final tax liability, you prepare something known as a statement of total income. So just a minute. You prepare something known as a statement of total income. With this, you arrive at the taxable income. With this, you arrive at the taxable income, and on this, pay taxes. On this, you will be paying the taxes. Now, if it is a straightforward working where there are no disallowances, allowances, no differences, nothing, then straight away your P&L as per financial statements will be your taxable income, and on that you will end up paying the taxes. Why this standard is introduced is, what happens is you will be having your P&L as per FS. When you multiply this with the tax rate, you will get some particular value. Okay, let us call that value X. Let us call that value X. Okay, now tax liability, which is nothing but the expense, will be Y. Will be Y. You tell me, is X always equal to Y or is it always different from Y? Is X always equal or always different? Yes? Come on. Is X always the same as Y or is it different? Prashant, Anushi?
It can be different, sir.
Mostly it will be different. It will be different. Very simple. Your depreciation as per Companies Act is always different from depreciation as per Income Tax Act. So it is never going to match. So therefore, X will never be equal to Y in your life. Okay, it will never be equal to Y. So for a reader of financial statements, this creates a problem. He knows the average tax rate. He knows your profit as per financial statements. Now, when he multiplies both of them and he calculates X, he will notice that in your financial statements, your liability is Y. But when he does the working, it is coming to X. X is not equal to Y. So obviously, questions will arise. Why is it not equal? What has they done? All those questions will arise. So we need to arrive at a proper accounting mechanism to give this explanation to the reader of financial statements that these are the components of income tax expense. It will have some current tax, it will have some deferred taxes, it will have probably some MAT credit entitlement. Okay, so when you do all these things put together, it will match the effective tax rate that you are looking at. Are we okay with this? Yes. So that is the objective. You want to give your reader of financial statements a comfort on the tax rate, the profit and loss, as well as the income tax expense that hits your P&L. That is the whole objective of Ind AS 12. Okay. So now you are going to understand the accounting for the current as well as future tax consequences of future recovery of carrying amount of assets recorded in the entity's balance sheet, transactions and other events recognized in an entity's financial statements. Outside the P&L, the related tax effects will also be recognized outside the P&L. For example, in other comprehensive income or in statement of changes in equity where applicable. Transactions and events within the P&L, the tax impact also goes into the P&L. Okay, so this is the basic. Where the original income or expense has gone, the tax impact also will go in that respective place. Okay, so now with this background, let us proceed to understand what do we mean by certain terms and definitions. Okay, one is your accounting profit or loss. Accounting profit or loss, this is nothing but your profit before tax as per financial statements. Okay, you can see here PBT as per financial statements. Now, let me be very clear. When we talk about income taxes, this standard is not what you can say is not addressing Income Tax Act 1961 in particular. Okay, this is drawn from IAS 12. IAS 12 is a set of principles for accounting for income taxes, which is applicable worldwide. So income tax acts are specific to countries, but IAS 12 is applicable for entities on a global basis. So what they are giving are principles, but when they give these principles, you must understand that it is not specific to any particular law. It is not specific to any particular statute. In this document, in this presentation, we have referred to certain sections, certain provisions of Income Tax Act 1961, but that is only for making you understand. That is only for making you understand. Please remember that Ind AS 12 is not at all referring to Income Tax Act 1961. It has no bearing on that. I am using the references of these sections so that you will be familiar to understand how the tax workings are happening, how the tax accounting is taking place. Okay, so basis that we are going to do our accounting. Okay, so for these purposes, so now when we start off with the profit before tax as per financial statements, we will add certain expenses, certain disallowances, which are non-deductible for tax purposes. For example, you have your 43B payments. That means 43B means all of us know that certain expenses which are allowable only when paid, Then you will add certain incomes which are not recognized but included under the tax laws. For example, any revenue that you are taxing on a receipt basis. You have received the income, you have received the money, but income is not yet accrued as per the financial statements. But as per the taxman, you have to take it as your income and pay tax thereon. Less expenses not recognized but deductible for tax purposes. For example, accelerated depreciation. You disallow Companies Act depreciation and you consider the income tax depreciation, which in most of the cases is accelerated. Less income recognized but not under tax laws. So in this case, we saw income now. So you would have received some income or some cash but income was not yet accrued. So that got taxed here. The same income, now you are accounting it in the books of accounts, but you will not tax it because it has already suffered the incidence of tax when it was received. So this is something which is income accrued, but it was already taxed on a cash basis. So these are some examples of allowances and disallowances that happen when we move from the profit before tax to the taxable profit or loss. So this taxable profit or loss is my second definition. It is the profit or loss in accordance with the applicable tax rules, which is nothing but net taxable income as per computation of income under the tax laws. Again, in India, this will largely cater to Income Tax Act 1961, but the standard per se, in any of the paragraphs, it has not at all referred to Income Tax Act 1961. So two definitions to take away from here: accounting profit or loss, that is the first definition, and taxable profit or loss, that is the second definition. Coming to the next one, tax expense. The expense that hits your P&L. In the P&L below the PBT, you have the tax expense that is made up of two components. One is your current tax and one is your deferred tax. Current tax expense, deferred tax expense. So when we talk about your current tax, it is nothing but amount of income taxes payable or recoverable in respect of the taxable profit or tax loss for a period. So this is straightforward. Whatever is your income tax payable or recoverable in respect of the taxable profit, it is talking about taxable profit. That means your net taxable income as per the statement of total income, So how do we calculate that? Taxable profit multiplied by the applicable tax rate. What will be the entry for this? You will debit the tax expense, current tax expense in your P&L, and you will credit provision for tax. Okay. Now, this provision for tax goes and sits under short-term provisions in your balance sheet, okay, as a liability. Now, as far as our laws go, we are required to estimate the tax and pay advance tax. Yes or no? We are required to estimate and pay the advance tax. Correct?
Yes, sir. Correct, sir.
Additionally, when we provide services or when we sell goods, our customers are also liable to deduct withholding tax. That is your TDS. Yes or no?
Yes, sir.
So in my books of accounts, I will have separately advance tax paid as well as taxes withheld by the customers which are paid on my behalf to the government. Yes. So these two things will be sitting as an asset in my balance sheet. Yes or no?
Yes, sir.
Now, when they are sitting as an asset for the particular year, and at the same time, I have a provision for tax sitting as a liability. Standard says you can offset the asset and the liability provided there is a legally enforceable right to set off the amounts and entity intends to settle on net basis or realize and settle simultaneously. Are we legally entitled to utilize the tax credit against the tax liability? Yes. We have advance tax. Can I utilize it against my provision for tax? Can I utilize it against my tax liability?
Yes, sir. Obviously.
Yes. Same goes for TDS. So there is a legally enforceable right. To set off the amounts. And obviously, we will be adjusting it. We will be settling it on a net basis. Whatever is the differential, I'll get a refund or I will pay depending on whatever is your payment status. If you have paid more advance tax, you will get a net refund. If you have paid short, you will do a net payment. So when that is the case, you can do an offsetting of the current tax assets, which is your advanced tax and TDS, and your provision for current tax that is sitting as a liability. Are we okay with this?
Yes, sir.
Yes. Now, the tax is measured at the rates expected to be paid to tax authorities using enacted or substantively enacted rates, which is basically this all the things gives what we are doing gives you an estimate of the current tax, gives you an estimate in the current tax. Are we okay?
Yes, sir.
Yes. All right, fine. So now with this, we have just prepared one question. Okay. This question is mainly to make you familiar. This is again, this has nothing to do with the Income Tax Act 1961. Okay. It has nothing to do with that. So we will just run through this and understand how the current tax gets calculated and how do we do the entries. Obviously, this type of what you can say, this type of a preparation of computation is not something that is seen in the examination. Okay, but you will look at the accounting implications of this. You will look at the accounting implications of this. Okay. So H Limited is a manufacturing company wanting to calculate its taxable profit or loss for the year ended 31st March. The statement of P&L and other comprehensive income, the statement of financial position, and the notes are given below. Tax rate for the year 7-8 is 30%. The new tax rate of 32% for the year 8-9 and beyond has already been enacted before the year end. Calculate taxable profit for the financial year 7-8 as well as the related current tax expense. Okay, so you are having the balance sheet, you are having the P&L extract, and you are having the notes. Okay, so now I will not run into the details of these adjustments. That is more on a tax purpose, tax basis, rather than on an accounting understanding. What you do is you start with accounting profit. You start with accounting profit, which is nothing but your PBT, 59,50,000. You will do certain add backs, you will do certain deductions, and when you do this, you are arriving at your taxable profit or loss. On this taxable profit or loss, you will multiply the existing tax rate of 30%, not 32%, because that is for the next year. Are we okay with this? So current income tax comes at 28,14,000. Entry will be current income tax expense debit, current income tax liabilities credit. Are we okay with this?
Yes, sir. Clear, sir.
Yes. So pretty straightforward, nothing much to explain in here. You can go through these adjustments just out of curiosity, but remember none of this is taken from Income Tax Act 1961. So don't ever fall into that trap. Don't ever fall into that trap. Okay. All right. Fine. Now, what else? So then after calculating current tax, we then move on to the next step, that is your deferred tax. We then move on to the next step, that is deferred tax. What is deferred tax? Amount of income tax payable or recoverable in future in respect of temporary differences, unused tax losses, and unused tax credits. Okay. So this is something which is arising in the future, which you are seeing in the future. So you are anticipating that and either creating a liability, a deferred tax liability, or a deferred tax asset. So let us understand this with the help of an example. Okay. There is a change in the approach. I will first explain the simple method of understanding based on what you have already studied. And then we will move on to the new balance sheet approach that is prescribed under Ind AS 12. Okay. So let us quickly run through that question. Okay. All right. TriStar Limited acquires a machine for 8 lakhs, decides to depreciate it straight line over its useful life of 5 years. Income tax legislation allows depreciating machines straight line over 4 years. In years 1 to 5, TriStar Limited's taxable income before tax depreciation is 4 lakhs and the tax rate is 30%. Before tax and depreciation expense is 4 lakhs and the tax rate is 30%. Show TriStar Limited's current tax expense, deferred tax expense, deferred tax asset or liability, and the net profit in the years 1 to 5. Okay, so shall we start?
Yes, sir.
Okay, so now your net profit without tax or without depreciation, okay, without tax, without depreciation is income 4 lakhs per year. Yes, income 4 lakhs per year, they have given that. Accounting depreciation, this is something you will have to calculate. So accounting depreciation 8 lakhs
Divided by
over
5 years.
5
5
years.
years.
8 lakh divided by 5, 1,60,000 per year. Are we okay with this?
Yes, sir.
Yes. Profit before tax 2,40,000 for each of the years. Yes.
Yes, sir.
If the question stopped here, you did not have any other data. Everything that is there in Income Tax Act has synchronized with the Companies Act. So if this was the case, 2,40,000 would be your profit before tax. What you can say, tax expense at 30%, 72,000 for each year. So net profit would be 1,68,000 per year. Are we okay with this? Yes. This
Yes,
is
sir.
tax expense should be. Okay. That means this is not the actual tax expense. This is what it should be. Now we look at the tax related depreciation. Opening carrying amount 8 lakhs. Yes, that is what they have given. TriStar acquires a machine for 8 lakhs. So 8 lakhs. Depreciable over 4 years. So 2 lakhs in each year. So 6, 4 and 2. Are we okay with this till now?
Yes, sir.
Tax depreciation.
Yes.
So now when I look at my current tax expense, I will start with taxable income. That is 4 lakhs each year. Next, tax depreciation expense. Tax depreciation expense is this. Tax depreciation is this. 2 lakhs each year because you are depreciating on a straight line basis over 4 years. So taxable profit is 2 lakhs. Current tax expense at 30% is 60,000 each year. But in the last year, it is going up to 1,20,000. It is going up to 1,20,000. So far, is it okay?
Yes, sir.
Yes. Prashant, Priyanka, Anushi, all clear?
Yes.
Yes, sir.
Okay.
Yes.
Now, look at this. Yes. For the first 4 years, my tax expense is 60,000. And suddenly in the 5th year, it became 1,20,000. Are you able to see this spike?
Yes, sir.
But is the taxable income the same?
Yes, sir. Taxable income is same.
taxable income is same, and what is the source of this taxable income? Yes, what is the source of this taxable income? The source of this taxable income is nothing but this. When we say the taxable income, we mean this is a wrong notation. We should mean the PBT. This becomes your taxable profit or income. The source is this 4 lakh rupees. Now, don't you think that something, what you can say, something unreasonable is happening? For 4 years, your PBT is 4 lakhs. For 4 years, your PBT is 4 lakhs and tax expense is 60,000. Yes or no?
Yes, sir.
In the 5th year, the PBT has not changed. It is 4 lakhs. But your tax expense is 1,20,000. Yes, your tax expense is 1,20,000.
Yes,
Don't
sir.
you think this will catch the attention of the stakeholders?
Yeah, definitely, sir.
Definitely, because they will look, why has my PBT remains the same, why suddenly my tax expense is increasing, is something that they are going to look into, Yes or no?
Yes, sir.
So why this 60,000 is becoming 1,20,000?
It's because the treatment given for depreciation is different than the in accounting and income tax.
Exactly. In accounting, your depreciation is 1,60,000 per year for 5 years. Whereas your tax depreciation is a set of 8 lakh SLM depreciation over 4 years. So what is happening is you are having accelerated income tax depreciation. Yes or no?
Yes, sir.
Correct? All right. Now, how do we look into that? Okay. See, this is what we have done. 1,80,000, 1,80,000, 1,80,000, and finally 1,20,000. This is your P&L with only current tax. Are we okay with this? Yes?
Yes, sir.
Now, let us understand. Your tax expense should be 72,000. Are you able to see this?
Yes, sir.
Number 2, without tax, without depreciation, your tax expense should have been 72,000. Yes? But currently it is how much? It is only 60,000. Yes or no?
Yes, sir.
So therefore, you have an upside of 12,000 immediately. Yes, you have an upside of 12,000 immediately. Yes or no?
Yes, sir.
Same way for year 2, 3 and 4. Same way for years 2, 3 and 4. Now, 5th year, 0. But do you still continue to have income tax depreciation? Yes. In the last year, you have a tax depreciation of 0. You have a tax expense of 72 and it should have been 72, but actually it is 1,20,000. So you are having 48,000 extra. Are you able to see this?
Yes, sir.
What is this 48,000 extra? This is nothing but 12,000 into 4. Yes.
Yes, sir. 48,000.
Priyanka, are you following?
Yes, sir.
Anushi, are you following?
Yes.
So, when I had to pay 72,000, I paid only 60,000. Have I saved the tax or have I only postponed the incidence of this tax?
Postponed.
You have only postponed. Can I say year 1, 2, 3, 4, I went on postponing? Yes, for each of the 4 years.
Yes, sir.
I went on postponing 12,000 and I paid it in the 5th year. And I paid it in the 5th year. Yes or no?
Yes, sir.
Yes.
So therefore, can I say that postponement, another word is deferring? Yes.
Yes, sir.
And deferring what? I am deferring the tax. I am deferring the tax. I am postponing the tax liability. Because it is a postponed tax liability, we call it as a deferred tax liability. We call it as a deferred tax liability. It is postponed to the 5th year. Yes?
Yes, sir.
Yes. Understood where the DTL is coming from?
Yes, sir.
Yes? Okay. Prashant, did you follow?
Yes, sir.
All right. Now, let us move on to the next one. So, my difference in taxes is 12,000 for the first 4 years with a reversal of 48,000 in the 5th year. With a reversal of 48,000 in the 5th year. Okay. So now, how do I do the accounting? I will be recording in each of these 5 years, whatever is your profit, that is your PBT as per the P&L. Then you will reduce accounting depreciation, 1,60,000 each. Okay. So that gives you PBT of 2,40,000. Current tax expense, same thing, 60, 60, 60, 60, and finally 1,20,000. Deferred tax expense, year 1, 2, 3, 4, I am only postponing it. That means I am incurring, but I am postponing. So 12,000 each will be your deferred tax expense. Yes or no?
Yes.
Yes.
Yes, sir.
And that is getting reversed in the last year. That is getting reversed in the last year. So ultimately, your net profit after tax will be 1,68,000. Will be 1,68,000. Yes or no?
Yes, sir.
Yes, this 1,68,000. Can I say that now it makes sense to my P&L because P&L has the same profit. Tax expense also is having the same, what you can say, tax expense is also having more or less the same profit, the same tax cost. Yes or no?
Yes, sir.
So that is the purpose of your deferred tax. Deferred tax effectively works on matching your liability to the profits that you are generating. Yes or no? It is effectively matching the cost to the expenses. It is effectively matching your expenses or tax cost to the profit that you are earning as part of the PBT, as part of the financial statements. Is it okay?
Yes, sir.
Yes. All right. So that takes care of the first example of deferred tax. Now I want you to try this particular question as homework. Okay. This particular section as homework. Okay. Next. Next. So this is something we did. I am asking you to do this particular question as a homework. As a homework. Okay. Just do it so that you will be having confidence on how to do this. Okay. On how to do this. Principles are the same. Here we created a DTL. Here you will end up creating a DTA. Here you will end up creating a DTA. Are we okay till now?
Okay, sir.
Yes. Now, this is the regular deferred tax workings that we understand, that we commonly do under AS 22. This is the same working that we are following. Is part of this problem. Okay. But actually, what the standard tells us, you need to come out of the P&L approach. In the last question, the last illustration, it was a P&L approach. We did the calculation taking P&L as the base. But now what the entity is, now what the standard tells is, you cannot take the P&L approach. You have to adopt something known as the balance sheet approach. You have to adopt something known as the balance sheet approach. Okay. So what is the balance sheet approach? The balance sheet approach essentially compares the carrying amount as per the tax laws, the carrying amount as per the books, and on comparison of both of them, you will recognize whether a DTA or a DTL has to be whether a DTA or a DTL has to be created or not. Is it okay?
Okay, sir.
Yes. So what is this balance sheet approach? Let us take the very same question that we did just now. The very same question. Okay. Now, look at your asset. First part is okay. This I don't have to look into much. Coming to deferred tax, first part is calculation of carrying amount. Carrying amount means books. Carrying amount means books. Okay. Now, your opening carrying amount was 8 lakhs when you first purchased the item of machinery. Yes or no?
Yes, sir.
And each year, 1,60,000 is your depreciation. So am I having the closing carrying amount with me? Yes. 6,40,000, 4,80,000, 3,20,000, 1,60,000, and finally 0. Are we okay with this?
Okay, sir.
Clear? Okay. Now, calculation of something known as the tax base. Calculation of something known as your tax base. What is your tax base? Tax base, we will look at the definition, but it is the amount attributable to an asset or liability for tax purpose. So under the tax workings, opening cost itself is 8 lakh, 6 lakh, sorry, opening cost itself is 8 lakhs. Depreciation each year is 2 lakhs. So your carrying amount, opening was 8, closing at the end of year 1 is 6, at the end of year 2 is 4, at the end of year is 4, at the end of year 3 it is 2, at the end of year 4 and 5 it is 0 and 0. Yes or no?
Yes, sir.
So now I have two sets of figures. One is closing carrying amount as per the books. The other is closing tax base. Just a minute, please. Okay. So I have my closing tax base as 6, 4, 2, 0 and 0. What Ind AS 12 tells us is, don't go through the long method of P&L and then arrive at your tax. Compare these two amounts, the carrying amount and the tax base. Okay. First year, your carrying amount 6 lakh 40. Tax base is 6 lakhs. So difference is 40,000. Difference is 40,000. Okay. I'll come to DTL etc. a little later. Okay. Second, 4 lakh 80,000 carrying amount. 4 lakh tax base 80,000. Year 3, 3 lakh 20, 2 lakh 120. 1 lakh 60, 0, 1 lakh 60. Up till here, is it okay?
Okay,
yes.
Sir.
Yes.
All right. Now you tell me the difference is 40,000 in the first year, 80,000 in the second year, 1 lakh 20 in the third year, 1 lakh 60 in the fourth year, and in the fifth year it becomes 0. That means at the end of year 5, your carrying amount ends up becoming equal to your tax base. Yes or no?
Yes, sir.
So can I say that this difference was there only for the first 4 years and then the difference does not exist?
Yes, sir.
Yes, Priyanka, Prashant, Anushi, correct?
Yes, sir.
That means, can I say that this difference is not of a permanent nature, rather it is of a temporary nature?
Yes, sir. Temporary.
So we call it as a temporary difference. We call it as a temporary difference. Okay? All right?
Yes,
Right,
sir.
sir.
Fine. And on this temporary difference, we calculate the deferred tax. On this temporary difference, we calculate the deferred tax. Okay. So 12,000. So this is temporary difference multiplied by 30%. Multiplied by 30%. So 40,000 into 30%, that gives you 12,000. Yes.
Yes, sir.
80,000 into 30% gives you 24,000. 1 lakh 20 into 30% gives you 36,000. 1 lakh 60 into 30% gives you 48,000. Sir, what are these? This is your closing deferred tax. This is your closing deferred tax. Yes or no?
Yes, sir.
This is your closing deferred tax. Okay. So when you look at your closing deferred tax and you compare it with the opening deferred tax, first year was 0, then 12, 24, 36 and 48. So your deferred tax expense will be 12,000. Will be 12,000 per year. Are we okay with this?
Yes, sir.
Okay. Okay, sir.
Okay. Now, question should arise, sir, why is it a liability? In the P&L approach, we understood very easily why it was coming as a liability. Here, how are you deciding it is a liability? So what you have to look at is, I'll come to the definition, but here is something I'll just explain before we move on to the definitions. Look at 6 lakh 40 and look at 6 lakhs. Suppose I earn 10 lakhs in the next year. Okay. Now, for accounting purposes, against this 10 lakhs, I have an asset worth 6 lakh 40. Yes or no?
Yes, sir.
I'm talking about the carrying amount. Against 10 lakh, can I say I have an asset worth 6 lakh 40?
Yes, sir. Yes, sir.
Yes. Let us hypothetically assume that this is the last year of depreciating this asset. Okay. I'm keeping the matter simple. It is the last year of depreciating this asset. Now, against 10 lakhs, I have a book value of assets worth 6 lakh 40. But I have the tax WDV of 6 lakhs. I have the tax WDV of 6 lakhs, correct?
Yes, sir.
Yes, sir.
Against the future profit of 10 lakhs, I can use only 6 lakh as a deductible tax expense. Yes or no?
Yes, sir.
Priyanka, are you following?
Yes, sir.
Prashant, Anushi? Yes.
Yes, sir.
10 lakhs. In the future, I can only adjust 6 lakhs. Yes or no?
Yes, sir.
This adjustment of 6 lakhs means I cannot adjust the differential value of 40,000 in the future. Yes or no? Because I've already taken the benefit right now. Correct?
Yes. Yes, sir.
So I cannot adjust this 40,000 in the future. That means at some point of time in the future, you will end up paying tax. You will end up paying tax on this 40,000. Yes or no?
Higher tax.
Higher tax. Because you are not getting that much expense in the subsequent year. Yes or no?
Yes, sir.
This 40,000, you have already enjoyed the benefit of that for tax purposes in year 1. Yes or no?
Yes.
Correct?
Correct, sir. We are paying the less tax.
Today we are paying the less tax. That means what? In future, this 40,000, what I have extra taken the benefit. 40,000 is your depreciation value. This 40,000 depreciation value which I have enjoyed today, it is a temporary enjoyment. After the reversal happens on this amount, I will have to make a tax payment in the future. Yes or no?
Yes, sir.
Yes, sir.
So therefore, it becomes my deferred tax liability. It becomes my deferred tax liability. Are we okay with this?
Yes, sir.
Prashant, Anushi? Yes? All clear?
Yes, sir.
Okay. So 12,000 rupee is your deferred tax expense for the first 4 years. And in year 5, the difference is 0. The difference is 0. That means the asset is fully recovered. Okay. Yes. Did you understand?
Yes,
So
sir.
now my point is, I want you to go through this once after your today's session. Okay, just to understand how the balance sheet approach works. Just to understand how the balance sheet approach works. Can you do that?
Yes.
Sure, sir.
Yes. So question 2 we have done in effect. Okay. Then it is just a matter of doing the same accounting that was done earlier. Okay. Next, I want you to try question 3, balance sheet approach also. This also I will be leaving it for homework. I'll be leaving it for homework. It is exact opposite of deferred tax liability. Okay. Yes. Anybody has any doubts till here?
No, sir.
Clear,
No
sir.
doubts? All clear. All right. Fine. So coming to deferred tax, I've already introduced the concept to you. So you should not have any problem understanding couple of these, what you can say, these points or the hierarchy to calculate the deferred tax. You have carrying amounts of assets and liabilities. We have already seen that. In our case, started off with 8 lakh, then end of year 1, 6 lakh 40. Then 6 lakh 40 became 4 lakh 80. 4 lakh 80 became 3 lakh 20, so on and so forth. You remember this? Yes. Then we saw the tax base. 8 lakh became 6 lakh, 6 lakh became 4 lakh, 4 lakh became 2 lakhs. Okay, computed the tax base. Next, step 3, compute temporary differences. Compute temporary differences. Temporary difference is nothing but step 1 minus step 2. Step 1 minus step 2. Yes?
Yes, sir.
Step 4, classify the temporary differences into either taxable temporary difference or deductible temporary difference. Okay, this is something that I will explain. What do you mean by taxable temporary difference? What do you mean by deductible temporary difference? I will look into it. Step 5, identify exceptions. Step 6, assess deductible temporary differences, tax losses and credits. Determine the tax rates, calculate and recognize the deferred tax, accounting of deferred tax, and offsetting DTA and DTL, and comply with other requirements of other Ind ASs. Okay, so we shall go one by one on this. Okay, all right. Any doubts so far?
Clear, sir.
All clear? Okay, just give me a minute. Yes. Now, step 1, we move on with determination of the carrying amount. What is your carrying amount? Very simple. It is the balance as per the ledger. Nothing else. We saw in our example 8 lakh minus 1 lakh 60, 6 lakh 40. 6 lakh 40 was your carrying amount. 6 lakh 40 minus 1 lakh 60, 4 lakh 80 became your carrying amount. So it is nothing but the ledger balance. The amount at which an asset or liability is recognized in the balance sheet after making necessary adjustments like depreciation, impairment, etc. That means this is your Ind AS value as per financial statements. That's it. You don't have to look at anything else. Are we okay with this?
Okay, sir.
Yes. Next. Tax base of an asset or a liability. See, there are two parts to this definition. I typically understand or I associate myself with the first part. That makes it easy for us to associate and understand what the standard wants to tell us. Okay. Second part is not difficult, second part is not what you can say, not complicated, but it may get sometimes a little bit confusing, okay, because of the way the standard is worded. But if you can remember the second part and if you are comfortable, well and good. Okay. What is tax base of an asset or a liability? It is the amount attributed to an asset or liability for tax purposes. Very simple. It is the amount attributed to an asset or liability for tax purpose. What does it mean? It means that suppose you are preparing a tax balance sheet, a balance sheet for income tax purposes. If you are preparing a balance sheet for income tax purposes, what will be the value of the assets or liabilities as per that? is what is your tax base. Are you able to understand? Yes. So
Yes, sir.
in our example, cost 8 lakhs, IT depreciation 2 lakhs, 6 lakhs. This is your carrying amount for tax records. For tax records. Yes or no?
Yes, sir.
So since this is your carrying amount for tax records, this becomes your tax base. Did everyone understand? Yes.
Yes,
Yes,
sir.
sir.
Swaminathan, Prashant,
Yes, sir.
Nushi. Yes. All right. Fine. Now, let us go to the definition. The items mentioned in the second part. Tax base of an asset. Economic benefits flowing from the asset are taxable, then tax base will be the amount deductible for tax purposes against any taxable benefits that will flow to an entity when it recovers the carrying amount of the asset. When it recovers the carrying amount of the asset. Are we okay with this? Yes. So I can use this machine, get economic benefits. Those economic benefits are taxable. Then the tax base will be amount deductible for tax purposes against any taxable economic benefits that will flow to an entity. So against this economic benefits that will come in the future, I will be considering 6 lakh as the amount that will be recovered. That will be recovered. That will be recovered. Are we able to understand? Yes. Yes.
Yes, sir.
Everyone? Priyanka?
Yes, sir.
Okay. If I am using this asset to generate something which is non-taxable, to generate an income which is non-taxable, then the tax base is equal to carrying amount of the asset, is equal to carrying amount of the asset. Shall we proceed?
Yes, sir.
Definitely.
Okay, okay, fine. When, when, when we talk about liability, the carrying amount minus the amount deductible for tax purposes in respect of that liability in future periods, if any. So that gives you your tax base of a liability. That gives you your tax base of a liability. Are we okay with this?
Okay, sir.
Yes. All right.
Yes.
Now, okay. I'm just seeing which example can I give for the liability. Okay, fine. Okay. Suppose we are looking at employer's contribution to Provident Fund, ESI, etc. Not employee, I'm talking about employer. Okay. Employer contribution to the PF is first of all a cost to the organization. Yes or no?
Yes, sir. Cost to the organization.
Cost to the company. So employee benefit expense account debit to
Payable or
payable. Yes, to PF payable. Correct? Agreed? Next, you will pay this. PF payable debit
to bank.
to bank. Okay. Paid in April 2025. Paid in April 2020. Okay. Now, for tax records, imagine you are writing the books for the income tax statute, not for accounting. Tell me one thing. Employer's contribution to PF. Again, I'm saying I'm referring to our own income tax act, but Ind AS has no reference to Indian income tax. Okay. Now tell me, PF employer's contribution. When will the tax department give a deduction?
The tax department will give in 2025 and 26. Accounting treatment will be given in 24-25.
Yes. This is the carrying amount. I mean, this is what you're doing in the books. I have accounted for the expense and paid in the subsequent period. But the tax department tells, look, I will not create a liability for this because these expenses are allowed on a payment basis only. Yes or no? So, tax department will not record any expense for this when it accrues. But when it is paid, the tax department would pass the entry EBE account debit to bank. Do you agree to this? Yes.
Sir.
See, this is notional. I'm trying to help you understand the tax base of a liability. This is notional. Okay, you will never prepare books for the tax department separately. Okay. So now your tax records, employee benefit expense insofar as it related to employee's contribution to PF will be nil for accrual purposes because these expenses are going to be incurred on a payment basis. Yes? Yes or no?
Yes, sir.
So can I say that tax department will not allow you to accrue a liability for this because this is a cost that needs to go only on cash basis and not on accrual basis. Yes or no?
Yes, sir.
Yes. So therefore, in your tax records, tax base of PF payable is how much? 0. Do you agree to this?
Yes, sir.
Yes. Priyanka, do you agree?
Yes, sir.
Prashant?
Yes, sir.
All right. Now, just try to understand. Now, this is the general understanding. Tax base will be 0 because this is an expense that will be allowed on payment basis. Okay. Now, let us understand. Carrying amount of PF payable is whatever it is. But can I claim a deduction of this entire amount when it is paid?
Yes, sir.
Yes. So, allowed in future.
On or before filing of the income tax return.
Oh, of course. Allowed in future against taxable profits. This becomes your tax. Do you agree to this? Yes.
Yes, sir.
This is nothing but the definition which is given here. Carrying amount minus amount deductible for tax purposes in respect of that liability in future periods. Are you able to understand?
Yes, sir. Given in the
Yes,
technical.
sir.
So carrying amount, it was there, but when it is paid, I will get complete deduction of that. So the tax base is dropping to 0. Did you understand this?
Yes, sir.
Yes, sir.
Yes. And look at this understanding. Are both of them matching to each other? Yes.
Yes, yes, sir.
If I'm notionally preparing a tax balance sheet, I will not accrue this cost. So it will not have any balance in the tax balance sheet because this is an expense which is allowed only on payment basis, on cash basis. तो इसका accrual हम नहीं लेंगे for the purposes of preparing the tax balance sheet. That is why the tax base of this cost is, of this item is 0. Did you understand? Priyanka, did you follow?
Yes, sir. Yes, sir.
Swaminathan, clear?
Yes, sir. Followed, sir.
Prashant, clear?
Yes, sir.
Anushi, clear? Yes?
Yes.
All right. Now, income received in advance. Okay. This is a normal liability. Okay. Regular liability. Now we move on to the second category. Income received in advance. Okay. What will you pass? Suppose I received money in 24-25. Bank account debit to advance received. Do we pass this entry? Yes?
Yes, sir.
All right. And in the future, advance received debit to income recognized. Do you agree?
Yes, sir.
So, I will again say this moves into the next year. FY 25-26. I am booking the income. Now, Tax base of the carrying of the resulting liability. Okay. Now, for tax purposes. For tax purposes, let us assume that this is a revenue or this is going to be an income that is suffering tax when it is received or accrued, whichever is earlier. Do you agree? Yes, this is an item of inflow which is taxable on receipt basis or accrual basis, whichever happens earlier. Do you agree to this?
Yes, sir.
So now, in year 1, when the money came, what will be recorded? Bank account debit to income received directly. Yes or no? Bolo?
Yes, sir.
Yes, sir.
So, when I am recording this income received, can I say that, therefore, tax base of advance received equal to 0? Can I say this? Because there is no liability only which got created in my tax balance sheet. Yes or no?
Yes, sir.
Income received is a P&L item. Bank account is a bank account. So you are basically looking at whether this advance received is going to sit here. It is not sitting. Do you agree to this? Are you able to follow? In your tax records, you got the money and you offered it for tax. It straight away went to the P&L. Do you agree?
Yes, sir.
Yes.
Yes,
Yes,
sir.
sir.
Advance received is a balance sheet item in your accounting records. But that advance received is not visible only in your tax records because you have already offered it for tax. In FY 25-26, will the taxman do anything? Answer is no. Because income was received and offered for tax on receipt basis. Are you able to follow?
Yes, sir.
Yes. Okay. So now when you look at the definition, revenue received in advance, tax base of the resulting liability is its carrying amount. Let us suppose the carrying amount is 100. That means I got money in advance of 100 rupees. So I would have passed the entry 100, 100. Advance received debit 100. Income recognized 100. Next, what would you do in tax records? You would do bank account debit 100 to income received 100. Tax base becomes 0. Now, it is the tax base is its carrying amount 100 less any revenue that will not be taxable in the future periods. Revenue not taxed in future. Sir, this 100 rupee is the carrying amount. Will it be taxable in the future? Answer is no. It is already taxed when it got received. So entire 100 is not taxable in the future because it is taxable now. So 100 minus 100, your tax base becomes 0. Are you able to understand this? Yes?
Yes, yes, sir.
Yes, sir.
Prashant, Geeta, Anushi, all clear?
Yes.
Yes, sir.
Yes. So you have two methods of looking at these things. The first method, imagine what will be the journal entries that will flow in the financial books. That you are already very good at, you are already very comfortable at. The next thing that you do is you look at the same entries, notionally assuming that you will be passing an entry in tax records. Okay, notionally. Okay? Yes. What you notionally will be passing for tax purposes, that itself becomes your tax base as long as it is part of the tax balance sheet. Yes or no?
Yes, sir.
Yes. Everyone, Anushi, Priyanka, Geeta, Prashant.
Yes.
Okay. So this is the first method. I typically prefer to follow the first method. Okay. But if you are very comfortable with the second method, I have explained the second leg of this definition also. Okay. Second leg also I have already explained. Shall we proceed further?
Yes, sir.
Yes.
Okay, sir.
So what I want you to do is you need to try all these questions for homework. There are lot of examples. There are lot of examples which are given in your study module. Okay, for identifying the tax base, etc., etc. Okay, so please try to do that and close it. All right. So try these questions. Coming next to your certain specific cases of tax base. Okay. Now, there could be certain items where there is a tax base, but there is no carrying amount. Okay. Sir, like for example, ऐसे कैसे हो सकता है? Do we really have that? है ना? Books of accounts. Books of accounts and tax books. Tax book. Okay. Now, preliminary expenses. Have you heard of this preliminary expenses? Yes.
Yes, sir. Initial expenses.
Initial expenses to set up an entity, so on and so forth. What does the tax guy do? Tax guy, FY 24-25, FY 24-25, bank account debit to, sorry.
It's preliminary expense to bank.
Yes. Preliminary expense debit to bank. Where do you think this preliminary expense goes in your tax records? Sir, you don't get 100% deduction of preliminary expenses. Section 35D. Do you remember section 35D?
Yes, sir. 1/5 will allow.
1/5 you are getting. Yes. So first thing is preliminary expense account debit to bank. Second, P&L debit to preliminary expense 20%. Remaining 80% will remain in the balance sheet. FY 25-26. P&L debit to preliminary expense. Another 20%. So on and so forth, it will continue. Are we okay with this?
Yes, sir.
Yes, sir.
Now, in accounts, what are you doing? preliminary expense debit to bank. Yes, preliminary expenses account debit to the bank. And where do these preliminary expenses go? Have you studied Ind AS 38?
Sir,
Yes.
it will go to asset side, sir.
Have you studied Ind AS 38? Have you studied Ind AS 38?
Yes, sir.
Yes. So does this qualify as an intangible asset in the first place? What is that intangible asset that you have? What have you done? Yes, you've not done anything. It does not meet the recognition criteria. So in Ind AS, preliminary expenses full value goes to your P&L. Goes to your P&L. Are you able to follow? Yes, 100% goes to your P&L. Yes?
Yes, yes.
So can I say that there is a tax base, but there is no carrying amount?
Yes, sir.
Yes. Okay. So that is what it is telling. Items having a tax base, but not recognized in the balance sheet. But not recognized in the balance sheet. The difference is obviously, what you can say, the difference is obviously temporary in nature. So there will be a reversal in the future. Okay. All right. So that takes care of certain specific cases. Okay. So go through these queries for homework. Okay. All right. Next. Okay. Fine. The next one is differences. Step 3. Step 1, carrying amount we saw. Step 2, tax base we saw. Step 3, temporary differences. Differences between carrying amount of an asset or liability, that means the book value, and the tax value. The book value and the tax value. Yes or no? Yes. So these temporary differences can be categorized into two types. One is a taxable temporary difference. One is a deductible temporary difference. So what is your taxable temporary difference? These are the differences which are giving rise to taxable amounts in future. Which are giving rise to taxable amounts in the future. Yes. So for example, in our first case, 6,40,000 was carrying amount of the asset. 6 lakh was the tax base of the asset. 6,40,000 carrying amount. Tax base is 6 lakhs. Can I say that this temporary difference, 6,40,000 to 6 lakhs, this temporary difference is nothing but something that will get sorted out in the future. But today, this difference exists. This difference exists because of different methods of calculating depreciation. This difference gets reversed in the future. It was 5-year SLM under the books. It is 4-year SLM under your tax records. So there are different reasons why you are having this difference. Now, this difference is allowing me to only adjust 6 lakh against the profits in the future, not 6,40,000. Not 6,40,000. Are you able to follow?
Yes, sir.
Yes. And therefore, since I'm only able to adjust 6 lakh, I have enjoyed 40,000 differential in current year. I can only enjoy another 6 lakhs. It ends up becoming a liability. It ends up becoming a liability. Are we okay with this? Yes, are we okay?
Yes, sir.
Priyanka, Geeta, Anushi. Yes, Prashant.
Yes, sir.
Okay. Now, deductible temporary difference is the opposite of this. Results in 9 months that are deductible in determining taxable profit or tax loss. Okay. That means this would entail certain uh, deductions. This would entail certain tax benefits in the future. This would entail certain tax benefits in the future. Okay. So we call them as a deductible temporary difference. We call them as a deductible temporary difference. Okay. Carrying amount. Okay. Now, this is your taxable temporary difference, deductible temporary difference. Okay. Next. Next. All right. So finally, classification of item as a deferred tax asset or a deferred tax liability. Okay. How do you calculate that? How do you determine that? So you have to understand if carrying value is greater than the tax base. Carrying value is greater than the tax base. For example, property, plant, and equipment. Carrying amount is there that is greater than the tax base of an underlying asset. So when you look at this, the relationship is inverse. That means I have identified an underlying asset as my taxable temporary difference, and that in turn gives you rise to a deferred tax liability. So what you have to see is, if carrying value is greater than tax base of an asset, then inverse, you will have a DTL. Are you able to follow? Yes.
Yes, sir.
Or no? If carrying amount is less than the tax base, direct relationship. Okay. Carrying value less than the tax base, deductible temporary difference. Giving rise to a DTA. So carrying value less than tax base, straight. Is it okay? Yes.
Okay,
sir.
sir.
All right. So done. Direct relationship. Carrying value less than the tax base of a liability. Direct relationship, straight relationship. So it will give rise to a DTL. A liability carrying value less than the tax base of a liability. Underlying is a liability, so it gives rise to a DTL. So this is typically how you can probably consider to remember. See, I don't find you guys to face any challenges on fixed assets, on property, plant, and equipment. You will be extremely comfortable with that. But you need to brush your computations for the liabilities. Because what happens is, we haven't been exposed to this form of deferred tax calculations earlier. We haven't been exposed. And therefore, it becomes incumbent upon us to practice more and more case studies of liabilities. Okay. Otherwise, by hearting this table and going will hardly take, it will hardly help you if you don't do the job, of practice on the ground. Okay, so please practice the questions so you will understand. Is it okay? Yes. All right. So now we have come to step number 4, closed. Homework. Read this and then do all these examples as homework. do all these examples as homework. Okay. All right. Fine. And even this one particular question as homework. See, this one question, what I have put in, this one question which I have put in is a very wholesome question. It starts with the balance sheet T&L. With that data given, you have to calculate the current tax. Then you are given the carrying amount. The same question asks you to calculate the tax base. The same question proceeds to calculate the deferred tax liability. So one question end to end is giving you the entire flow of Ind AS 12. Okay, so please do that question. Okay, next. So do this for homework. All right. Now, calculation of deferred tax asset or liabilities is done. Okay, all right, fine. Next, identification of exceptions. We will come to do this at a later point after the break. So you can have a quick 10-minute break and we shall resume at 8:40. Okay, we shall resume at 8:40. Break, please. Step number 1, determine the carrying amount. Step number 2, determine the tax base. Step number 3, temporary difference. Step number 4, identify DTA or DTL. So these were the first 4 steps. The next 5 steps or 6 steps pertain to determining exceptions, application of rate, etc., etc. So we run through those steps, and that should, close your deferred tax in totality. So step number 5, identify exceptions. See, we will move on a balance sheet wise basis, identifying for each and every line item of the balance sheet, what is your carrying amount, what is your tax base, what is the difference. Now, there are certain exceptions. Okay. What are those exceptions and why do we have those exceptions is something that we will now look into. See, recognition of deferred tax asset or liability for goodwill arising in a business combination. Okay. Now, see, we studied goodwill in brief yesterday. Do you remember? Yes. We studied in brief goodwill. Yes?
Yes, sir. Yes, sir.
Why does goodwill arise? You take over the net assets of the entity while consolidating. You would have made a payment, purchase consideration. Payment would be extra than what you got. So this gives rise to goodwill. Now, the carrying amount of goodwill is some figure. Okay, there is some goodwill that comes on consolidation. What about tax base? Can anybody tell me what is the tax base of goodwill in a business combination? First of all, tell me, is business combination, consolidation a recognized item under the tax laws?
No, sir, it's not tax deductible.
It typically goes in as not tax deductible. I didn't even ask tax deductible. I meant to ask, is consolidation, is business combination something that we recognize under income tax as a concept, or are income taxes on an entity basis rather than on a group basis? Applicability of income tax, is it on a group basis or on a standalone entity basis?
A standalone entity base, sir.
That's right. So the tax base of this goodwill will always be zero, because you will never have your goodwill in your life. Yes, you will never have this goodwill. Okay, in tax, because tax doesn't understand consolidation. Today, I have Reliance Industries Group, which comprises of 100, 200 subsidiaries. But that is only a corporate reporting requirement. The taxman will never understand what the consolidated financials of Reliance will mean. For the taxman, it is Reliance standalone, Reliance Retail standalone, Reliance Trend standalone, so on and so forth, is something that he will look into. And he will never look into consolidation, because this is a PAN-based law. It is a PAN-based law for each of the individual entities. So your tax base will always be zero. Also, as he said, for tax profits, goodwill is not tax deductible. So you could take the other view also, that goodwill is not tax deductible. Goodwill is not even deductible when subsidiary disposes of the underlying business. So the tax base is nil. Tax base is always nil for goodwill. Okay. Now, I have a carrying amount of goodwill the carrying amount is greater than the tax base, which is 0. Correct? So tax carrying amount is greater than the tax base of goodwill, which is an asset. So technically, I should have a DTL. Do you agree with this? Do you agree with this?
Yes, sir.
As per pure concept, do you agree? Forget that we are doing exceptions. Anushi, Priyanka, Prashant. Just because we are done step 1, carrying amount of goodwill. Let us suppose it is 100. Tax base of goodwill is 0. So carrying amount is 100, tax base is 0, carrying amount is greater than the tax base. So therefore, if carrying amount is greater than the tax base, then it is pertaining to an underlying of goodwill, which is an asset. So it gives rise to a DTL. Is everybody okay with this?
Yes, sir.
Yes. Now,
Yes, sir.
we are not recognizing this goodwill. Let me explain why. Let me explain why. See, in a business combination, the takeover entry looks something like this. Net assets account debit to bank to give rise to goodwill. Is it okay?
Yes, sir.
Now, suppose I recognize a DTL on this goodwill. Then to DTL, this will be goodwill into tax rate. Yes. Now, because this has gone up, again my goodwill will change because goodwill is a balancing figure, right?
Yes, sir. Definitely it will change.
So if this will change, again my DTL will change.
Yes,
Yes.
sir. It will keep on change.
So again the goodwill will change. These two are interdependent on each other. Okay, goodwill changes because it is a balancing figure. DTL will change because goodwill keeps on changing. It gives rise to a circular reference. It gives rise to a circular reference. For this purpose, initial recognition of goodwill, we do not create a DTL. Did you understand? Yes.
Yes, sir. Yes, sir.
Prashant, Geeta, Priyanka, Anushi, did you understand?
Yes, sir.
Yes, sure.
Sure, sir.
So, on initial recognition of goodwill, do not recognize DTL. Obviously, if I have not recognized DTL on initial recognition, anything in relation to the initial recognition, for example, impairment loss, you will not recognize the goodwill, the DTL in relation to an impairment loss because you have not recognized goodwill in the first place. Because you have not recognized goodwill in the first place. So you will not recognize. In case of goodwill, which is deductible for tax purposes and does not arise from initial recognition, then you can go ahead and recognize the DTL. Then you can go ahead and recognize the DTL. But mostly you will not. At least in Indian laws, goodwill is not tax deductible. So therefore, you will never be able to recognize the DTL in relation to goodwill. Are we able to understand? Yes?
Yes, sir.
So this is your exception. This is your exception. Okay. So you can go through this question, similar question to what we have done. Okay. So just the figures will be different. Okay. All right. Next. Temporary differences on initial recognition of an asset or a liability. Okay. All right. Okay. A temporary difference may arise on initial recognition of an asset or a liability. Example, if part or all of the cost of an asset will not be deductible for tax purposes. So nature of the above transaction, in a business combination with limited exceptions, identifiable assets and liabilities acquired in a business combination are fair valued at the date of acquisition. But the tax base of the identifiable assets and liabilities are not affected or affected differently. Okay, so what they are trying to say is when you do a business combination, you typically end up doing a fair valuation exercise of assets and liabilities taken over. But from a tax perspective, the tax base of the identifiable assets which we have taken over, they are not affected. If the transactions affect either accounting or taxable profit, so if this is the case, DTA or DTL is recognized. This affects goodwill or bargain purchase gain recognized by the entity. See, for accounting purposes, I will do a fair valuation. But for tax purposes, there is no fair valuation. So that creates a temporary difference. So please go ahead, recognize the DTA or DTL. See, what this is saying is, in the case of mergers or amalgamations, okay, what we call as commonly all of this covered under business combination. You take over assets. Asset 1, 2, 3. Liability 1, 2, 3. Okay. All of them put together gives you what we call as net assets. Are you okay with this? Yes, this is your net assets. These net assets are at fair value because business combination requires you to do a fair valuation of all identifiable assets and liabilities. Are we okay with this?
Yes, sir.
But for tax purposes, net assets at book value. Net assets at book value only. Yes? Are you able to follow?
Yes, sir.
Net assets at book value only. All right. So, this is at fair value. This is at book value. Will it create a difference?
Yeah, definitely, sir.
Definitely it is creating a difference. This difference could either give rise to a DTA or a DTL. Do you agree to this?
Yes, sir.
So in the takeover entry, what will be passed is assets at fair value debit, assets at fair value debit, liabilities at fair value credit, to bank. This is the purchases that you have. This is the purchase consideration that you have discharged. Okay, I'm keeping it very simple. 2, you will either have a DTL on account of these differences. Okay, you will have a DTL on account of these differences. The difference will give rise to a goodwill. You could also have a DTA, nothing, I'm not biased against DTA. You could also have a DTA, whatever it is, one of the two will be there, DTA or a DTL. Are you able to follow? The difference gives rise to goodwill. Is it okay?
Yes, sir.
Geeta, did you follow?
Yes, sir.
Anushi, Priyanka, Prashant?
Yes, sir.
Yes, sir.
Okay. This DTL, what we are seeing here, is not the same as this DTL. This DTL is on the goodwill, which we are not supposed to recognize because of the circular reference. But this DTL, the second one, this one, is not giving rise to a circular reference. This is the DTL or DTA pertaining to all other assets and liabilities other than goodwill on account of business combination. Are you able to follow?
Yes, sir.
This you have to recognize. Okay, this you have to recognize. Okay, so they are saying DTA or DTL is recognized. DTA or DTL is recognized. Next. A temporary difference if the transactions affect either accounting or taxable profit. Recognize DTA, DTL and corresponding income or expenses in the profit or loss. Okay, so that is your next one. And last one, transactions not falling in A or B above. Example, purchase of asset or receipt of government grants. DTL or DTA is not recognized. Subsequent changes on, say, for example, on depreciation of asset, that is also not recognized. Okay. All right. Fine. So these are those identification of exceptions, further part. Okay. Next. Okay. I can leave this part for homework except question 7 and 8. Let me see. An entity received a government grant of 15 lakhs. Okay, this is the same question which I am doing. Okay, this question. Received a government grant of 15 lakhs, parked it in deferred income under non-current liabilities. The grant is non-taxable. Can the related deferred tax asset be recognized? Government grant shown as a deferred income means it sits in your liability as a non-current liability. Okay. Tax base is 0 because it is a exempt grant. Due to carrying amount being greater than the tax base, carrying amount is 15 lakhs, tax base is 0. It results in a deductible temporary difference. By virtue of exceptions, since the transaction does not affect accounting or taxable profit on initial recognition, it is not a business combination, the related DTA will not be recognized. Even when income from deferred revenue is recognized in P&L, the income will not be recognized as it would be pursuant to initial recognition. You will not recognize. Okay. Government grant, etc. You will not recognize. Okay. Next. Entity set up a factory in a backward area at a cost of 50 lakhs, against which it received a government grant of 10. The grant is set off against the property as per Ind AS 20 and is shown at 40 lakhs. For tax purposes, the same is not deducted. The related tax base is 50 lakhs. Can the DTA be recognized? Can the DTA be recognized? Okay. So now, since the transaction does not affect accounting or taxable profits on initial recognition, related DTA will not be recognized. Related DTA will not be recognized. Okay. So that is question 8. Okay. Next. Ind AS 32. We have done financial instruments. I think we haven't done financial instruments, right?
Have done, sir.
You have done?
Yes,
Okay.
sir.
Okay. Then what I will do is, we will do this example. I will run you through this example. Then we come to the theory so that you will be in a position to understand the theory better. Okay. So now when I look at this question, okay. Slater Limited issues 1,000 convertible bonds on 1st April at par. Each bond is redeemable in 3 years' time at its par value of 2,000 per bond. Alternatively, each bond can be converted at the maturity date into 125 rupee 1 shares. The bonds pay an interest annually in arrears at an interest rate on a nominal value of 6%. This is your coupon rate. Prevailing market rate of interest for 3-year bonds with no right of conversion is 9%. Required, show the presentation of the compound financial instrument at inception. The 3-year discount factors are given below. Also discuss deferred tax implication if for tax purposes the convertible loan has to be recognized at the face value of 20 lakhs. Are you okay with this? Question? Understood the question? Yes? Yes? So now, income tax does not know Ind AS 109, Ind AS 32, वो सब पता नहीं रहता उनको. Okay, they don't know. So for them, tax basis 1000 into 2000. Straight away tax basis 20 lakhs. Is it clear till now? Yes?
Yes, sir.
Yes, sir.
Have you done financial instruments? Or is it only a reading activity that is happening for this question? Be very honest. There is no problem. Okay?
Myself not done, sir. Yet to be done.
Not done. What about Geeta and Anushi?
We have not done.
Sir, not
So
done.
done.
Not yet done. So what I will do is, but who is this lady? Priyanka. You have done it, right?
Yes, sir.
So what I want you to do is, I want you to understand this working. You have already done it before. Okay.
Sir, please explain. We can able to understand, sir. Please explain to us.
Okay.
Yeah.
All right.
Yeah, please explain.
See, I will explain the mechanical calculation. Okay. Why do we do that? That reasoning I will, because that is a very long reasoning. Okay. It will take another 2 hours for me if I have to explain why do we do this. Okay. All right. So
we will understand the logic behind on the this income tax purpose.
Yes, what you can do, all of you, is today I will run you through the mechanical workings of Ind AS 109. यही workings आपको आएंगे every time, but the logic behind that, I would suggest you please run through the financial instruments. Okay, so that I'm not going to cover. So as per Ind AS 32, a convertible bond we need to split between debt and equity component. This is the first thing. How are you going to split? You will use the discount factor applicable to prevailing market interest rate of 9%. So you will do this. The value of the bond is regarded as the present value of outflows of the bond using the interest rate of 9%, which is as under. Present value of bond payable on maturity 20 lakhs. You will be getting the maturity after 3 years. So 20 lakh into 0.772. This is 9%. So this is 9% present value factor 3rd year. Okay. So 15 lakh 44,367 is the present value of the principal. Interest annuity 20 lakh, 6% is the coupon, 2.531. This is present value annuity factor 9%, 3 years. 3,03,755. So debt component is 18 lakh 48,122. Your value of the bond is 20 lakhs. So the difference is 1,51,878. 1,51,878. Are we clear till now? Yes.
Yes, sir. Basically, they are computing the present value of the bond as well as the present value of the interest.
Yes.
And they are adding it to it, and they are calculating the redeemable value on the future date.
Yes. Yes. Geeta, did you follow? Anushi, did you follow?
Yes, sir.
Yes, sir.
That's the calculation you understand. So the present value का जो calculation है, which gave you this 18 lakh 48, that is your liability or debt component. The balancing figure is your equity component. Okay. So now when you look at your bond, how does it move? 18,48,000 is your opening, this value. Interest will be now at the rate of 9% because that is the market rate of interest, 9%. You have paid 6%. So 18,94,453. 18,94,453. That is your opening, interest, paid, closing. So that comes to 20 lakhs. Are you okay so far? Yes. I have covered up till here. Till now, is it okay?
Yes, sir.
Geeta, did you follow? Yes. Swaminathan, did you follow?
Yes, sir. It look like lease liability computation.
It is like a lease liability computation. Yes. Yes, exactly. So till 20 lakhs, we have gone ahead. Okay. Next. The total interest component which has hit is 5,11,878. And total payment which has happened is 3,60,000. Okay. Now, look at your deferred tax. See, for tax purposes, what is your tax base? What is your tax base?
Tax base is 20 lakhs.
Tax base is 20 lakhs. A taxman will not understand. Taxman will not understand what is Ind AS 109, what is Ind AS 32 and all. He will not understand. Okay. So now, opening carrying amount of the bond is 18,48,000. Tax base is 20 lakhs. Tax base is 20 lakhs. Okay. So 18 minus 20, opening taxable temporary difference is 1,51,878. Do you agree with this? Yes?
Yes, sir.
Why is it a DTL? Can you tell me? See, carrying amount of liability 18,48,122. And here I am having tax base of liability 20 lakhs. Yes.
Sir, yeah, when the carrying amount is less than the tax liability, we have to create that TTL.
Carrying amount of liability is less than tax base of liability. Underlying is a liability. So correct. You have to create a TTL.
Yeah, it is a direct effect. It's not the inverse effect.
Yes. So here, the DTL opening is 1,51,000 into 30%. So 45,563. Is it okay? Yes. This is
Yes,
your
sir.
difference into 30%, 45,563. Yes or no?
Yes, sir.
So,
Closing 18,94,453. This figure 18,94,453. 20 lakhs. 20 lakhs. Okay. So
Again, detail will come.
again a DTL will come, but that DTL is reducing. Closing DTL is 31,664. That means there is a reduction from 45 to 31, 13,900. Okay.
Yeah, to the extent already recognized, we want to reverse it.
Yes, you will reverse it. Yes. Next, opening is okay. Closing is passed already, and then the closing is passed. Okay, so this is how you will do the adjustments. This is how you will do the adjustments. Okay. Any other doubts as far as this table is concerned, everyone? Yes. as far as this table is concerned, do we have any doubts? Swami,
No, sir,
Geeta,
clear, sir.
Priyanka, Anushi,
All clear, sir.
Prashant?
Yes, sir. Yeah.
Okay. Now, what is the journal entry? First, when you have the proceeds being collected, bank account debit 20 lakhs, to equity 1,51,878, to liability 1848,122. Then equity account debit to DTL 45,563. Why equity? Because the difference went and sat in equity. The difference went and sat in equity. Is it okay? Is it okay? Yes.
Yes, sir.
We saw the very first slide. I will recognize a DTA or DTL at the original place where the difference is sitting. Yes or no? Students don't remember.
Yes, sir. We are remembering.
Yes, sir.
Transactions and other events outside the P&L, related tax effects would be recognized in statement of changes in equity. That means equity means SOCE only. All right. So that is why it went and sat in SOCE. Okay. Next. Interest expense 1,66,000. Next. Liability to bank 1,20,000. Deferred tax liability to P&L 13,899. Year 2 interest expense 1,70,000, which is to the P&L. Liability to bank 1,20,000. DTL 15,150. Interest expense to liability 1,75,046. Transferred to P&L, liability discharged. Deferred tax will be closed at the end of the third year. Because we have touched 20 lakhs in terms of tax base, and that is what is your carrying amount also, tax base also. So therefore DTL should be 0. So that is how it works. Okay. All right. At the end of third year, DTL fully reversed and becomes nil. DTL is reversed to PL as interest on bond is debited to PN. Okay. Accordingly, reversal also gets credited to the P&L. All right. Any doubts so far here?
No, sir.
No, sir, clear, sir.
So it's just a mechanical way of doing, but anyways, that covers a lot of things. Okay. All right. So step 5, we have done this question also. Next. Okay. Just go through this. I'll be back in a minute. Okay. Okay. Now, investments in subsidiaries, branches, associates, as well as interests in joint arrangements. Okay. Existence of undistributed profits, foreign exchange rate changes, reduction to recoverable amount. All these three cases recognize a DTL specifically, always, except for you have two criteria. There is a control over timing. Non-reversal is probable. In such cases, do not recognize a DTA. A DTA shall be recognized only if it is reversal is foreseeable in the future and taxable profit is available. So in these cases, you will recognize a DTA. DTL will always be recognized. We'll come to this a little later. It is not easy to understand right now because you guys have not yet done consolidation. Okay, but nevertheless, for the time being, you can just remember this. DTL should always be recognized except for two cases. DTA shall be recognized only if two conditions are met. Okay, all right, fine. If you remember, we had studied this day before yesterday, I think, in days 21. No, this was yesterday only. Non-monetary assets and liabilities of an entity are measured in its functional currency under Ind AS 21. If the entity's taxable profit or loss is determined in a different currency, changes in the exchange rate give rise to temporary difference that result in a recognized DTL or DTA. The resulting deferred tax is charged or credited to the P&L. Do you remember this yesterday? Yes. We used to calculate from functional currency to, we used to determine it from foreign currency to functional currency using the rates which were prescribed. But tax department has its own method of calculating. So it will give rise to a temporary difference. That difference will be giving rise to deferred tax. That deferred tax we should charge or credit to the P&L. Are you able to understand this?
Yes, sir.
At least here, I think you should be having a connect. Yes? Yes?
Yes, sir.
Okay. All right. Next. You can read this for now. Okay. Just out of curiosity. Once you do your associate, joint venture, subsidiaries, that time you will be able to understand this in detail. Okay. All right. Fine. Next. Step number 6. So exceptions we covered, but your step number 6 starts getting important. Step number 6, assess and reassess deductible temporary differences, tax losses and tax credits. Okay. Deductible temporary differences, deductible temporary differences, DTD. These give rise to DTA. Yes, these give rise to DTA. Yes or no?
Yes, sir. Taxable temporary difference, it will give to TTL.
Yes, TTD gives rise to DTL. Okay. What is the entry for DTA that will be passed? Deferred tax asset account debit to P&L. Okay. Tell me one thing. This deferred tax asset, deferred tax liability, do they involve cash flows or is it only a book entry nature?
Only the book entry. It's notional income, notional expenses.
Notional income, notional expense, only a book entry. That's right. So now tell me, if an entity wants to show profit from this tax, can he reverse the DTA? Or can he create the DTA, sorry?
Yeah, once if TTA is created, the income will be high.
Okay. Now, let me ask another question. In India, we have the what do I say? The provision to carry forward the losses for 8 years. Yes?
Yes, sir.
Consider a startup. Startup has losses for 10 years, 12 years, 15 years. Yes?
Yes, sir. Definitely, it will have.
So tell me one thing. First of all, you tell me existence of taxable losses. Is it a DTA or a DTL?
It's a DTA, deferred tax asset.
Yes. Others, girls, are you able to understand? An accumulated loss is a DTA. You are able to follow that, right?
Yes, sir.
Yes, sir.
Because in the future, when I adjust it, my tax liability will go down. So it gives rise to a DTA. Now, let us think you are working in a startup which is burning money for 10 to 12 to 15 years. Will you still keep a DTA?
No, sir, it's not required.
It is not required. So what my point is, a DTL you create freely, there is no problem. But a DTA appears to be anti-conservatism because you are creating an asset. You are creating an asset recognizing the corresponding income. You are creating an asset recognizing a corresponding income even when it may not be certain, even when it may not be certain, which is why the standard says assess and reassess deductible temporary differences, tax losses, and tax credits. Because you are recognizing an income which is not yet realized, which will not be realized. But by virtue of the standard, you have to recognize the DTA. So therefore, when I have to recognize my DTA, one second. Yes. When I have to recognize my DTA, an entity should recognize DTA only when I can use the DTA. You cannot create a DTA and write it off tomorrow. You should be able to use that asset. You should be able to display that you will get benefit of DTA from that asset. Benefit of tax savings in the future. Only when it is probable that taxable profits will be available. Only when it is probable that taxable profits will be available against which the deductible temporary differences can be utilized. Against which the deductible temporary differences can be utilized. This is based on principle of prudence or conservatism. Recognition of DTA due to deductible temporary differences. That means your DTA you are creating. There are sufficient taxable differences. So for every deductible temporary difference, you must assess that there is adequate taxable temporary difference. So that the DTA that arises in the future can be set off against the DTL that you need to pay in the future. Okay. So you can create only if there is sufficient taxable differences. It is probable that taxable profit will be available. Hence, DTA recognized in the period in which deductible temporary differences arise. Are you able to follow this? Yes?
Yes, sir.
And if there are insufficient taxable differences, recognize DTA to the extent that entity will have sufficient taxable profit or tax planning opportunities are available that will create taxable profits in appropriate periods. Are you able to follow? Yes? Are you able to follow? Your DTA has a cap limited to the extent of available taxable profit or to the extent that tax planning opportunities are available. Did you understand, Swami, Prashant, Geeta, Priyanka, Anushi? Yes?
Yes, sir. Only to the extent the future profit availability are based on that taxable profit. Okay, tax planning based on the tax planning.
Geeta, did you follow? Priyanka?
Yes, sir.
Sure. You have any hesitation, please let me know. Okay.
Yes, sir. Can you give example of this, sir?
I'm coming to give you an example only now. Okay. Yes. See, entity will do this or will do this. Okay. Let us do this. The entity at the balance sheet date should see whether there are sufficient taxable temporary differences whose reversal pattern matches with the reversal profile of deductible temporary differences. Okay. See, as at 31st March, entity has both taxable and deductible temporary differences with the following reversal pattern. What does it mean? It means that, see, I have an opening difference of 10,000. Current year, I mean in year 1, I can reverse to the extent of 5,000. That means a DTL will become a liability in the future. So 5,000 will be reversed. The DTL will drop down to 5,000. 5,000 in the second year, I can utilize 3,000. 2,000. 2,000 I can utilize in the third year, it becomes 0. Did you understand this part? Yes?
Yes, sir.
This is very similar to that fixed asset question we saw, right? To that fixed asset example that we saw. Just a minute. See, look at the reversal pattern. DTL 12,000 first year, 12,000 first year, 24,000 second year, no reversal pattern, 36,000 third year, no reversal, 48,000 fourth year, no reversal, 0. That means the reversal pattern is everything is reversing in the fifth year. Did you understand this? Yes, Geeta?
Yes, sir. Yes, sir.
So on similar lines, in this case, opening difference, reversal in the first year is 5,000. Reversal in the second year is 3,000. Reversal in the third year is 2,000. Is it okay? Yes?
Yes, sir.
Yes.
This is going to give rise to a DTL. So here, always recognize. Always recognize. Apart from exception list. Apart from exception list. Is it okay? Yes?
Sir, I'm not getting it. Can you please explain it once more?
1 minute. Which part did you not get, beta?
Sir, like
1 minute.
the reversal one.
1 minute. Did you understand this part?
Yes, sir.
See, in this case, I create a deferred tax liability. Otherwise, we'll go to the differences only. In the first year, there was a difference of 40,000. This 40. Yes, you are able to see what I am shading?
Yes, sir. Yes, sir.
This 40 got increased to 80,000. Is there a reversal of the difference here?
Sir,
40 is moving on to 80. You are able to see this?
Yes, sir.
Is there a difference or is there additional difference getting added?
Sir, additional difference is there, no?
80 is, that's right. 80 is moving on to 120. So is there additional difference or reversal of difference?
Sir, additional difference is there?
Correct. 120 is moving on to 160. Is there additional difference?
Yes, sir.
160 is dropping down to 0. What is happening here?
Sir, reversal?
Reversal is happening here. So this you understood?
Yes, sir.
Now
Yes,
you
sir.
come to this. Opening difference was 10,000.
Yes, sir.
I have reversed 5,000. I have that much reversal that will happen in year 1. So 10
Okay, sir.
to 5, closing comes to 5. Okay.
Yes, sir. Yes, sir.
This 5 is the opening. Second year, I have a further reversal of 3000. Okay.
Yes, sir.
So
Yes,
it
sir.
comes to 2. And 2 gets reversed in the third year. Taxable difference becomes 0 at the end of year 3. Is it okay?
Yes, sir. Clear.
Now, parallelly, there is a deductible temporary difference. This gives rise to a DTA. Okay. The
Yes, sir.
deductible temporary difference. Now, everybody listen very carefully. The deductible temporary difference reversal pattern is something like this. There is an opening of 8,000. It reverses to the extent of 4,000, leaving a closing balance of 4,000. Opening of 4,000, reversal of 3, closing of 1. Opening 1, reversal of 1, closing balance is 0. Understood this part? DTA, the deductible temporary difference, this part you understood?
Yes, sir. Yes,
Okay.
sir.
Now what the standard tells is, now be very careful. Okay, what the standard tells is, I can recognize this deductible temporary difference only if two conditions are fulfilled. Either, what is deductible temporary difference? It is basically an item of expenditure that you can claim in the future. That you can claim. It is deductible in the future. Deductible का मतलब क्या होता है? Future taxable profits के सामने you get the deduction of this. Did you understand? Yes?
Yes, sir.
Yes, sir.
Anushi, did you follow?
Yes, sir. Yes, sir. Yes, sir.
So, suppose I did not deduct. Okay, forget that. Let me take an easier example. Nowadays, you have MSME disallowance. All of you are aware of it. Yes.
It has to be paid within 45 days. Then only allowed.
MSME payments have to happen within 45 days. Otherwise, if it doesn't happen, whatever is outstanding on 31st March will be disallowed. Yes?
Yes, sir. Yes, sir.
This is 43B, I think clause H or something it is. Okay? It will be allowed when it is paid. Agreed?
Yes, sir.
Anushi, did you follow? Priyanka, do you follow? Swami, do you follow?
Yes, sir.
Yes, sir.
Prashant, do you follow? Yes?
Yes, sir.
It will be allowed when you have paid. But tell me one thing, the benefit of this disallowance, you will get only if the future is a taxable income year. Yes or no?
Yes, sir.
See, suppose I have not paid my vendors to the tune of 1 lakh rupees. In the future, if I have a loss or no profit, will I be able to get this benefit of 1 lakh even though I have paid it?
No.
No. You will get a benefit only if your taxable profit is at least 1 lakh in the future. Then your tax liability will drop down to 0. Are you able to follow?
Yes.
Yes, sir.
Yes, sir.
Priyanka, Anushi, Geeta, did you follow this?
Yes, sir.
Yes, sir.
Today, by disallowing an MSME, I have a deductible temporary difference. But I should get the benefit, I should enjoy this benefit because in the future I should have taxable profits to enjoy this benefit. Do you agree? Yes?
Yes, sir.
Yes, sir.
Girls,
Yes, sir.
disallowance 1 lakh. That will be your allowance in future subject to existence of taxable profits. Do you agree, everyone? You should have at least 1 lakh of taxable profit, taxable income. So against this 1 lakh of taxable income, you will claim this as an expense, show that nil profit, therefore no tax in future. Are you able to follow?
Yes, sir.
Yes.
Yes, sir. Yes, sir.
One of the conditions to recognize a DTA is you should have sufficient taxable income in the future. This is the first point. Yes.
Yes, sir.
Second point is you should have adequate taxable temporary differences whose reversal pattern matches the reversal pattern of deductible temporary differences. Did you follow? Let me rephrase. This 1 lakh deductible temporary difference is getting reversed in the next year because I have done the payment. Is it okay?
Yes,
Yes,
sir.
sir.
Yes. Now, suppose I have assets. The difference 2 lakhs in the first year, it fell down to 1,60,000 in the second year. Did you understand? I am taking this very much, this case. Okay? 40, 80, 120. I'm just modifying it slightly. So I have a deductible temporary difference of 2 lakhs, sorry, a taxable temporary difference of 2 lakhs, out of which 40,000 is getting reversed in the next year. That means what? 40,000 will be an amount that will be added to your taxable profits. Yes or no?
Yes, sir.
Come on, Geeta,
Yes,
Anushi,
yes.
do you follow?
Yes, sir. Yes, sir.
That means in the future, understand, I have a deductible difference of 1 lakh getting reversed, and I have a 40,000 rupees of taxable temporary difference getting reversed. Yes or no? 2 lakh is falling to 1,60,000. That means reversal of 40,000 is happening. Yes?
Yes.
Yes, sir.
An example, okay? This is just an example that I'm taking. So 40,000 taxable temporary difference is getting reversed. That means, in effect, though I have a benefit of 1 lakh, I am also having a liability of 40,000 hitting. So my net benefit that is there is only 60,000 rupees. Yes or no?
Yes, sir.
1 lakh minus 40, 60,000. Geeta, did you follow?
Yes, yes, sir.
Yes, yes, sir.
Did you follow? Anushi,
Yes,
did you
sir.
follow?
Yes, sir. Yes, sir. Yes, sir.
That means now coming to the last part, just a little more focus. Okay. If I have 40,000 taxable temporary difference, 1 lakh deductible temporary difference, I should be able to demonstrate that in the future I should be generating at least 60,000 worth of taxable profit for me to justify creation of a DTA in respect of 1 lakh worth of deductible temporary difference. Did you follow? Yes?
Yes, sir.
Yes, sir.
Not convinced or convinced. That yes is not having that tone of convincing. I am not convinced that you are convinced. Okay. Taxable temporary difference. It was 2 lakhs in year 1. In year 2, it becomes 1,60,000. Reversal 40,000. Deductible temporary difference 1 lakh in year 1. It becomes 0 in year 2. Why? There is a reversal of 1 lakh. So when I pay this 1 lakh in year 2, taxable profit will be some figure less MSME paid. You do it like this only, right? Yes or no?
Yes, sir.
One.
Yes, sir.
Now allowed on payment. So 1 lakh. Add. You will not do directly taxable temporary difference, but I'm just making it up. Add taxable temporary difference 60,000. So sorry, not 60, 40,000. 40,000 is reversing. So 1 lakh minus 40,000. Yeah. Yes. So 1 lakh minus 40,000. So that gives you 60,000. What is this 60,000? You need to still have either liability creations worth 60,000 or profit worth 60,000 to utilize this asset in the future. Yes or no?
Yes, sir.
Yes, sir.
Are you able to follow now? Geeta?
Yes, sir.
Yes?
Yes, sir.
Yes. So this is additional liability needed or additional taxable profit to be demonstrated. Only then you can create a deferred tax asset on the entire deductible difference of 1 lakh. Otherwise, you can create only a deferred tax on the extent you can utilize. That is this 40,000 rupees. Did you follow?
Yes, sir.
Yes or no?
Yes,
Geeta?
sir.
Yes, sir.
Clear, sir.
Okay. Anushi? Yes.
Clear, sir.
That's it. So coming back to our discussion, look at this. Opening deductible difference, reversed 4,000, closing 4, 4, 3, 1, 1, 1, 0. Now look at this. There is a reversal of 5,000. Oh, sorry, too dark. There is a reversal of 5,000 liability. There is a reversal of 4,000 on account of asset. Do I have adequate liability reversal for the asset reversal?
Yes, sir. We have adequate.
Girls,
Yes, sir.
Geeta,
Yes,
Anushi, yes, everyone? Right.
Yes, sir.
Where is Prashant? Prashant, do we have adequate reversal?
Yes, sir. Yes, sir. Yes.
So, that is matching in year 1. Year 2, liability reversal 3,000. Asset reversal 3,000. Do I have adequate liability to match the asset reversal?
No, sir.
Are you have na beta 3,000 ka
Yes,
liability
1,000.
reversal
Yeah,
hai.
1,000.
So it's equal. Like DTL,
It's
then
equal.
DTL is
You
equal.
have equal. No problem. You have equal. Equal also means adequate. Yes.
Yes, sir.
Year 3, my liability reversal is 2. My asset reversal is 1. Do I have adequate liability reversals to match my asset reversal?
Yes, sir.
Yes, Prashant, Anushi.
Yes, sir.
Yes, sir.
In all these 3 cases, for each of the years, I have adequate deductible, I have adequate taxable differences getting reversed in line with the pattern of reversal of deductible differences. Yes or no? So therefore, I can recognize entire 8,000 as my deductible difference into tax rate to give you the DTA. Did you understand? Yes,
Yes, sir.
Sir. Yes.
Anushi?
Yes, sir.
Okay, perfect. तो वो खत्म हो गया. So this is the first part. Existence of taxable temporary differences. Next, look at this case. Look at this case. Year 1, 5,000 getting reversed, taxable, but deductible is 4,000. Do I have adequate?
Yes, sir. We have adequate.
Yes.
We have adequate.
So I can recognize entire 4,000. Year 2, 3,000 taxable differences reversal, but deductible is 4. Do I have adequate?
No, sir. 1,000 is inadequate.
1,000 is short. So to the extent of 3,000 only, you can recognize the deductible temporary differences. Yes or no?
Yes, sir.
That is what the standard tells, right? If you do not have adequate reversals, then restrict your deferred tax asset or restrict recognizing the deductible differences to the extent of reversal pattern of taxable temporary differences. Okay. Last case, nothing is there to reverse in the deductible differences. So you will book only 7,000.
Yes, sir.
Anushi, Geeta, Prashant.
Yes, sir. Yes, sir. It's clear.
Existence of taxable differences. Okay. Okay. Now, continuing the further. Same question. So here I had 4,000. Here I have 3,000. So I can recognize 7,000. Correct? Yes, because 5 getting reversed against 4, 3 getting reversed against 4, so I will recognize 3. Ascertain the DTA that can be recognized if it is given that entity expects a profit of 750 in year 2. So now you have 750 rupees more, right? So you can recognize a deductible difference of 7,750. Did you follow? Yes?
Yes, sir.
Yes, sir.
Okay. Prashant?
Yes, sir.
Okay, fine. So, probability of future profit. So, you look at both of them together. Don't look at it one by one. Okay, all right. So, go through this for homework. It's more of a theoretical question. Go through all these questions for homework. Okay, all right. Next, existence of tax planning opportunities. An entity has a deductible difference of 50,000. That means to this extent, he can save your taxable income. That entity is having this amount available. It has no taxable temporary difference against which it can be offset. So no taxable differences. It is not anticipating any future profits. Now profit है ना reversal of taxable differences है. 50,000 is only deductible differences. However, it can implement a tax planning strategy which can generate profits up to 60,000. That means in the future, by virtue of tax planning, it can generate 60,000 worth of profits. Yes, do you agree? The cost of this tax planning strategy is 12,000. That means the available profit is 48,000. Do you agree to this?
Yes, sir.
60,000. Yeah.
Prashant, Anushi,
Yes, sir.
Swaminathan, yes?
Yes, sir.
All right. So, compute the deferred tax that should be recognized. You have a difference of 50, but available value that you can use is 48,000. So you will recognize a deferred tax to the extent of 48,000. Are we clear with this?
Yes.
Yes, sir.
Yes, sir.
So 48,000 is what you are going to recognize. So that closes this out. Okay, illustration 7. All right. So you will have to, okay, so this is on the DTA recognition. Availability of reversal of taxable differences, availability of profits, availability of tax planning opportunities. Did you follow? Yes.
Yes, sir.
Yes, sir.
Reassessment or review of DTAs. You have to reassess it every year. You have to review the DTA every year. It has become probable that future taxable profit will allow the previously unrecognized DTA to be recovered. Recognize previously unrecognized DTA. You would have left something unrecognized. In that example, 1,000 worth of difference was unrecognized. If you have sufficient profits now, recognize that 1,000. Similarly, reduce the DTA if you don't have the profits or you don't have the differences. Anything you don't have which will allow you to utilize a part of the DTA. So all these things you can consider to reduce the carrying amount of DTA. Is it okay? Yes. DTA is very sensitive. DTL, calculate and put everything. No special rules for DTL. For DTA, there is a lot of emphasis because this is going to hamper the conservatism principles if you don't do it carefully. Did you understand?
Yes, sir.
Yes.
Geeta, Anushi, did you understand?
Yes, yes.
Yes, sir.
Yes. All right. Next, measurement of DTA or DTL. Abhi to we were finding out only the differences. These differences you need to multiply it by the tax rate. Which tax rate are you going to consider? Should you consider current tax rate or future tax rate? You tell me.
So current tax rate, we have to, if it is substantially enacted, then we have to consider that.
Current tax rate is already enacted. Future tax rate, if it is substantively enacted, you can consider the future rates. Okay? Yes, because normally the budget that comes out is for the next financial year. So therefore, that tax rate you will be considering for the purposes of your deferred tax calculation. So differences into tax rate gives you a DTA or a DTL as the case may be. Okay, so you can check for homework. They call this for homework. Okay, all right. Distribution of dividends measured at the rate. Okay, this you can just read it for your understanding. Calculate and recognize deferred tax. Taxable differences into tax rate gives you a DTL. Deductible into tax rate gives you a DTA. Do not discount deferred tax assets or liabilities. Consider laws enacted or substantively enacted. Carrying amount of DTA to be reviewed at the end of each reporting period. Accounting for deferred tax consistent with how you have accounted for that transaction or event. What has gone to the P&L, tax effects also will go to the P&L for those transactions and events. What is outside the P&L, say in OCI or SOCE, it will go and sit there. Okay. Next. Carrying amount of DTA, DTL may change even when there is no change in related temporary differences. For example, change in tax rates or tax laws or tax laws, reassessment of recoverability of DTAs, or change in expected manner of recovery of asset, resulting deferred tax recognized in P&L unless it is outside the P&L. So very simple. Carrying amount will change even if there is no change in the differences. Offsetting current income tax, you can offset legally enforceable right, intention to settle on net basis. Deferred income tax, when current tax can be offset by the same tax authority. Okay, all right. Next, temporary differences arising in a business combination. You will have to recognize the DTL or a DTA. Okay, all right. Fine. So this business combination, once you finish it, you can refer this particular section. Okay. All right. Have you done share-based payment transactions?
Yes, sir.
Yes.
Yes, sir. Done, sir.
Okay. So in share-based payment transactions, you are creating something known as an SBP reserve. Yes or no?
Yes, sir. We create the super.
Yes,
And
sir.
that SBP reserve you go on utilizing as and when the options get utilized or whatever it is, that SBP reserve goes on getting utilized. Yes, you will first create it in the vesting period, employee benefit expense account to SBP reserve. Later on, when it gets exercised, SBP reserve debit, cash debit to equity share capital to securities premium. Isn't this how you do it?
Yes, sir.
Yes. Now, for tax purposes, deduction is allowed. Tax deduction is available in respect of remuneration paid in shares, share options, or other equity instruments of the entity. Amount of tax deduction may differ from related cumulative remuneration expense and may arise in a later accounting period. Okay. For an entity may recognize an expense for consumption of employee services received as consideration for share options granted in accordance with Ind AS 102. But tax department may not give a deduction till the options are exercised. Okay. So if the amount permitted as a deduction in future periods is not known at the reporting date, we shall estimate based on available information. Then measurement of deductible differences would be based on entity share price at the balance sheet date. Okay. So this is your share-based payment transaction. You can go through this for homework to understand how it is done. Change in tax status of an entity or shareholders, consider going through it just for your academic interest. And then you have your disclosures. Okay, you can run through these disclosures to see what all disclosures. I think there are 15 disclosures that are broadly covered. Okay, remaining are all questions which you could be trying once you refer the sessions. Okay, so that's it on my part as far as Ind AS 12 is concerned. Okay, any doubts, anybody so far?
Sir, could you please run through the disclosure alone once?
1 minute. Disclosure number 11, huh? Any specific disclosure? See, what all are you going to disclose? You should disclose the components of tax, current tax, deferred tax, prior period tax, MAT credit utilization, all these things you should disclose. Next, tax related to items charged directly to equity you need to disclose because it is not appearing in the P&L separately on the face of the P&L. Tax related to items recognized in other comprehensive income also shows separately. Explanation of relationship between tax expense and accounting profit. This is important. You need to do your effective tax rate calculation. Effective tax rate workings. Okay. This is something you need to do. ETR working. Okay. Next. Change in tax rates disclosed. Unrecognized deductible temporary differences. I told you what should be unrecognized. Unused tax losses, unused tax credits disclosed. Temporary differences associated with investment in subsidiaries. Amount of DTL or DTA or income or expenses you need to show. Discontinued operations, the tax expense relating to them. Dividend tax if you have. Disclosures in case of business combination, what is the change if a business combination in which the entity is the acquirer causes a change in the amount recognized for its pre-acquisition DTA. If the DTA benefits acquired are not recognized but are recognized after acquisition date, give the description of event or change that caused the deferred tax benefits to be recognized. Deferred tax asset and evidence based on future profits. That is important. Tax consequences of distribution of dividends, tax relation contingencies, change in tax rates or tax loss. Okay, so these are some of the disclosures that you would typically be expected to give in your financials. Yes, any doubts? Anybody? Yes,
Thank you, sir. Thank you, sir.
no doubts, all clear?
Yes.
Yes, sir. Clear, sir.
Okay, what about Prashant, Geeta, Anushi?
Yes, sir.
So everything is clear.
Okay. Please go through the major sessions because there I have 2 days. I could have been I would have definitely solved some questions and done things in more detail. So please go through that before you consider uh, uh, referring the revisionary class. Revisionary class, we are running fast because of time boundaries. Okay, there we have 2 to 3 sessions, so we can do a lot of questions. So I hope you go through those sessions. Okay, especially for revisions on consolidation and financial instruments, I think you should go through the detailed session before you can do the revisions. So that will be of great help to you. Okay.
Thank you, sir.
All right. Thanks. Thank you, everyone.
Thank you,
Thank
sir.
you.
Thank you so much.
Thank you, sir.
Okay, sir. Session conclude.